Okay, good afternoon, everybody. Thank you for joining this Invest Engine webinar in partnership with Invesco, all about how to invest globally. I'm Andy Prosser. I'm the head of investments at Invest Engine, and I'm joined today by Chris Meller, who is a product specialist at Invesco. So, hi, in terms of the plan for the webinar, I'm going to hand over to Chris in a second. He's got a presentation he's going to run us through. After that, I'll do a really quick demo of how to find the Invesco ETFs on the Invest Engine platform. Then for the final 10 minutes or so, we've got time for a Q&A with Chris at the end. So if you do want to ask questions as we're going through the webinar, you can click, there should be a Q&A button in the bottom of your screen. The questions won't be broadcast to the whole webinar chat, they're coming straight to us. So don't worry, if you think you've got a stupid question, absolutely fine. Just feel free to ask away and we're going to answer as many as we can at the end. Now, it's my job to make sure that everything runs on time. So I need to make sure that I leave enough time at the end for a quick platform demo and the Q&A. So I'm hoping that once we've wrapped everything up, we'll be ending the webinar at about 5:45-ish, 5:40, 5:45, something like that. I'm in charge of the slides today, so please forgive me if there's any technical snafus. Chris, if I forget to move on, please just nudge me. Before we get going, I do need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. Okay, all that out of the way, without further ado, I'm going to hand over to you, Chris, to get things going. And maybe just as a kind of starter for 10, perhaps you could set the scene a bit for us. You know, we see a lot of investors on Invest Engine's DIY platform investing in only one market. You know, usually that's the US, but sometimes that's the UK as well. So it might be useful just to kind of start with an intro into why investors might want to consider taking, a bit more of a global approach to their portfolio construction.
Yeah, perfect. And first of all, thank you for having me to speak today. It's always enjoyable. And I guess the first thing to say, the title of the slides is "What does the world mean to you?" So we're going to focus on global equity market exposures here, and looking at ways to get the world in one ETF. The reason I'm going to talk about world ETFs or global ETFs is a simple one. It's all about diversification in reality. Lots of investors, will perhaps invest in an area that they're familiar with, a name they recognize. There's often a domestic bias to investment selection. But actually that can be quite damaging to the long-term performance or potential long-term performance of a portfolio. So if we jump to the first slide, in the deck, you can see on the left-hand side here, it's a fairly dense chart, or a fairly dense slide. But if we look on the left-hand side here, we can see the long-term cumulative performance in sterling terms for an investment in 4 different indices. So this is looking at UK is the dark blue line, USA is the light blue line, Japan is the pink line, and MSCI Europe ex UK. So Europe without the UK is the sort of slightly dirty magenta line or mauve line. And what you can see is that there's pretty big divergences in performance over the last 55 years. Quite clearly, the US equity market has outperformed versus all of those other indices that we're looking at. However, there are periods of outperformance and underperformance. So the most notable one is Japan in the late 80s, going into the 90s, where Japanese equities effectively did what US equities have done over the last decades, and absolutely blew the doors off in performance terms, and then subsequently has gone into the doldrums for the best part of 40 years, quite famously. The key problem for an investor is identifying which area is the right one to invest in at any given time. And we always say past performance doesn't predict future returns. It's on every single slide with a performance line on it. And the reality is that it is very difficult to say what's going to happen in the future. And for that reason, diversification is your friend. Now, there's obviously that long-held statement that there's no such thing as a free lunch in finance, but the closest thing to a free lunch is diversification. That was said by a Nobel laureate economist. when talking about portfolio construction. And you can see on the right-hand side here, 3 lines that are giving you the correlation between the UK equity market, so this UK equity index that we're using, and the other 3 performance indices that you can see on the other chart. And you can see that correlation varies over time. So, the higher the correlation, the more similar the performance is, the more similar the drivers of those performance. The lower the correlation, the less similar the performance. And for a diversified portfolio, lower correlation is good news in terms of spreading out risk. The aim being that when you're having a problem in one part of your portfolio, you're perhaps hopefully making money in another. You can see quite clearly that correlations are different. Perhaps unsurprisingly, a higher correlation between European equities and the UK than there is, for example, between UK equities and Japan. But having this diversified portfolio is potentially hugely beneficial to long-term performance. If we jump to the next slide, you can see what that looks like in a sort of one-stop shop portfolio for like the FTSE All World Index. So in this case, we're looking slightly shorter period because we have less back history on the FTSE All World Index. But we're looking at the performance of the UK market that we had before, the dark blue line, and the FTSE All World Index in sterling terms again is the light blue line. And you can see that clearly a diversified global portfolio like the FTSE index has outperformed versus the UK broad market index, in particular over the last 10 or 15 years. It's a little hard to see on the left-hand side of the chart because it's swamped by the size of the move more recently. But there are periods where the UK outperformed and periods where the UK underperformed. But most obviously, that underperformance has happened in the last decade or so. And by having just a pure domestic focus, you would have missed out on all of that potential upside. So if we look at the next slide, what this is showing is some of the weights, or the weight of the US equity market in 2 different global indices. So I'm looking here at the FTSE All World Index and the MSCI World Index. And what you can see is that you're getting a slightly different outcome in terms of US equity exposure. And actually, the weight in the US is in the FTSE All World Index, that outperformance in the US that we saw in the first chart is what's driven that outperformance versus the UK primarily. So actually having a decent weight in the US has been good news over the last decade. What this chart is really illustrating, though, is that a world index, a global index, they're both the MSCI World and the FTSE All World Index both have world in their name, but they're not exactly the same beast. And you can see that in this chart that the MSCI World has a higher weight in US equities than the FTSE All World Index. The reason for that is that the universe of stocks that they're selecting from is different. So the MSCI World Index is basically taking the largest stocks across equity markets in what MSCI define as developed market exposures. So that's around 23 different countries, and they're taking the 85% of the market cap of those indices of those countries to build an index and look at the performance of the developed world index. The FTSE All World Index has a broader starting universe, so it's including both developed and emerging markets, and extending that out to more than 30 countries that it's selecting from, which dilutes some of the exposure to developed markets and some of the exposure to the US that you can see here. In terms of the impact that has, if you jump to the next slide.
Sorry, just jumping quickly on this one. Is it fair to say then that the FTSE All World is a better, or at least a more accurate representation of the global market? It's a bit more diversified because this All World, the FTSE All World, also includes emerging markets, whereas the MSCI World doesn't include those EM companies.
Yeah, I think that's a fair description. You know, if you think about what is the investable universe you have to choose from as an investor in equities, in shares in companies, yeah, the FTSE All World is capturing that additional group of countries in the emerging market space. You know, so that includes countries like, you know, like China, for example, or South Korea or Taiwan. So you know, what is defined as developed versus emerging, you know, some people could argue over that for many years, but you know, some pretty big economies and some pretty big markets get lumped into the emerging market space. So by not including them, you're missing out on some opportunities, I guess, is the way to think about it.
Yeah, no, that makes sense.
In terms of the difference, the impact that has on performance, you can see that on the slide that's on the screen now. It's very hard to see the difference if we look at the line here. You know, over the very long run, you're looking at you know, extremely strong performance from equity markets in general over the period that we're looking at here, over the 24 or slightly more years. And it's splitting hairs ever so slightly, but you do get periods where the FTSE All World has outperformed. You get periods where the MSCI World has outperformed as well. So if we look back to, you know, the noughties, you know, following the bursting of the tech bubble, when internet stocks were doing very well in the late 90s, and in particular helping drive performance for the US equity market higher. You know, the FTSE index, you can see, pulled ahead from, you know, the low in the market, or in fact earlier in that period, through to you know, a decade or so ago, and since then you've seen the MSCI World Index outperforming. And if we look at the numbers at the bottom, you know, over the last 12 months to the end of February, the MSCI World Index in sterling terms returned 16.7%. That's about 0.8% ahead of the FTSE All World Index in sterling terms. Just a word of warning: we've included for regulatory purposes or compliance purposes the performance of our ETFs that are tracking those indices. Those are expressed in dollar terms, so it's a slightly different number. The number is a bit lower because the dollar has been weakening against sterling over some of that period. So there's a bit of a difference there. But ultimately, the index you choose will have an impact on the performance that you receive. Fairly obvious. So in terms of where we're going next, I've talked a lot about global standard market cap weighted indices. One of the things I'd like to touch on is thinking about other ways of getting exposure to the global equity market. So, you know, we've seen the impact that having exposure to the US, or changing the exposure to the US, has had between the MSCI World and the FTSE All World Index. One of the reasons that you've seen significant outperformance from US equities over the last decade has been because of the strong performance of just a few key stocks, and people will probably be familiar with the sort of the phrase of the moment, the Magnificent Seven, which are the seven large tech stocks, mega cap tech stocks, that have helped to drive the outperformance of the US equity market. One of the things that's brought with it, though, is an increase in index concentration. So we talked right at the start about the benefits of diversification. The reality is that, you know, if large cap stocks keep on outperforming as they have done over much of the last decade, or for long periods of the last decade, you'll get more and more weight in a standard market cap weighted index in just those few names. The chart on the left-hand side illustrates this for the MSCI World Index, where the weight of the top 10 stocks, and this is looking at the top 10 stocks over the last 50 plus years, in the MSCI World Index, the weight of the top 10 stocks is currently at a 40-year high. It accounts for more than a quarter of the index. So in an index with around about 1,500, 1,600 stocks in it, the 10 biggest names accounts for a quarter of the weight, and therefore is, you know, in effect driving, you know, a large proportion of the performance of that index. You can see that that's pretty extreme in terms of concentration. So if we go back to the internet origins period, or the tech bubble as it's often referred to, where in the late 90s we had tech stocks being priced off of multiples of sales, or multiples of clicks, or whatever. This was the boom of the internet, and saw a lot of companies do very well in terms of market performance, only for it to end with the bursting of that bubble, and a sell-off that lasted for the best part of 3 years, from late 2000 through to 2003, early 2003. And you can see that concentration came back again. There have been a number of other previous periods in the past where concentration has reached high levels. We've picked out a few there. The blue chips story of the 1970s. The big stocks in the US market were the sort of go-go firms of the time, and again gave very good performance initially, and then ultimately were replaced by the next generation of exciting areas. Similarly, the oil explosion in the late 70s and the early 80s. The Japanese financial story, which helped drive that Japanese outperformance in the late 80s and into the early 90s. And most recently, the AI story that we've seen. The key thing you'll see is that I put on the right hand side here the list of the top 10 stocks at each of those peaks in concentration in the index, and it's very hard to see many of the top 10 names from one peak surviving till the next peak. So if you're concerned about concentration, the potential problem with a market cap weighted index is that you are putting a quarter of your money into those 10 names at the end there, and the key question is whether they'll continue to outperform.
Yeah, I won't ask you that question, but it's obviously a really topical thing to think about given the market drop that's happened in the last few weeks. If you are concerned about market concentration, then what can you do about it? We've been talking about market cap weighted indices up until this point, and you might be about to talk about it, but are there any other kind of ways of weighting an index, a global index, in a way that's different to market cap?
Yeah, so if you think about market cap weighting, all that's doing is, I probably should have defined this earlier, but all it's doing is putting the amount of investment into an individual stock is proportional to the market capitalization, so the share price value multiplied by the number of shares in issue. And that's a great way of measuring the average performance of the global equity market. You're effectively making the assumption that you own all of the equity market, or a small proportion of it. It's not necessarily the best way to actually deliver performance. Over the long run, we know that controlling costs is hugely important, and therefore, the growth in ETFs that we've seen in, over the last decade or so has been driven by the fact that low-cost market cap weighted index exposures has been a very good way of getting exposure to the market. But there are other ways that you can do that. Another simple way, and actually it's the very first index design. The very first index that was launched was the Dow Jones Industrial Average Index, and that's taking a very simplistic approach of weighting the performance of stocks by their share price. So ignoring the number of shares in an issue, ignoring the total value of the company, just doing it based on share price. And there are a few indices that still do that. It's not very replicatable, and it's not very representative, but it's a very easy way of calculating things. Now, I wouldn't suggest that that's the best way of getting exposure, or indeed dealing with market concentration. A couple of possibilities. An easy one is equal weighting, and you've seen significant growth in equal weight index approaches, and that does exactly what it says on the tin. Rather than putting 25% or 26% of your investment into those 10 stocks on the right hand side here, an equally weighted MSCI World Index is going to give you 1/1600th of your portfolio exposed to each of the stocks in the index, and that's clearly going to diversify away that concentration risk. Another way of doing it, which is quite interesting, is if we jump to the next slide, is to think about fundamentally weighting rather than equally weighting, or market cap weighting. So you can see on the left-hand side here, I've just put on the performance of a company. It might be a very well-known member of the Magnificent Seven at the moment. And what I've done is I've put two things on this chart. One is the market capitalization on the right-hand side scale. The other is the number of shares outstanding on the left-hand scale. And you can see that light blue line, the number of shares outstanding doesn't change very much. The market capitalization, however, has gone from, around $500 million 2 or 3 years ago to $3 billion today. So, a six-fold increase, in market cap, and that's been driven by a six-fold increase primarily in share price. If you're market cap weighting, the higher the share price goes, the more weight effectively you would be putting into that stock when you were buying into the index. Nothing to do with the change in shares, just purely driven by price. Fundamentally weighting is taking an approach that is trying to find a more stable measure of size. Now, Research Affiliates, or RAFI as they're known, is the company that pioneered this approach with their fundamentally weighted indices. And what they're taking is the four fundamental metrics that you can see on the left-hand side here. That's sales, and they're taking a 5-year average of sales, so they're looking for long-term, indications of company size. They're taking book value, and book value is the value of the assets on the balance sheet of a company, so assets less liabilities. Cash flow, they're looking at a real-world measure of performance, financial performance, as it were. So cash flow is a difficult measure to manipulate. Either the company is getting cash in or it's not. And finally, dividends. Again, if a company is distributing and paying dividends, it's a fairly good indication of a sort of continuity of potential performance. And what RAFI are doing is basically taking an average of those numbers, or an average of the impact of those numbers, but basically saying that ultimately, I don't care what the share price does, because share prices can become excessively high or excessively exuberant, shall we say, and also they can become excessively depressed. So what I want is a more stable measure of the value or size of a company that I should be investing, and going from there. If you jump onto the next slide, you can see the impact that has in terms of performance. I think it's fair to say that normally when you put up a performance chart in a presentation like this, it's going up from bottom left to bottom right. It's hard to believe that sometimes they do go down. In this case, there's a very good reason why it's gone down over the full period. So if you look at what the FTSE RAFI All World 3000 Index has done in the first half of this chart, you can see that it outperformed versus the MSCI World Index from the late 80s through to the tail end of the financial crisis in 2009, 2010. There was a brief period, there was a multi-year period in the middle here from mid-90s to 2000 where it underperformed, and that was as that tech bubble expanded that we were talking about before, and then it outperformed as the tech bubble deflated. More recently, by more recently I mean over the last decade or so, the fundamentally weighted approach has underperformed because large cap equities have been the key driver of the market, and the Magnificent Seven have continued to take markets higher. And in that world, being underweight those mega cap stocks is not going to help your performance. So if you're concerned about the potential for those more growthy mega cap names, then a fundamentally weighted index is more likely to give you the sort of performance that you saw in the first parts of this chart, and the performance we've seen over the last decade, if the market starts to broaden out and you start to see, less of a concentrated focus in just a few names.
That makes a lot of sense. We actually had a question in the chat. I'm going to ask you now while you're kind of thinking about these fundamentally weighted indices. Somebody's saying, actually a really good question. I feel like market cap ETFs are easy to find and almost the default for investors. But what do we look out for in ETFs that are fundamentally weighted? So I guess it's when you're looking at fundamentally weighted ETFs, what kind of characteristics should you be looking for? What goes into your decision-making process?
Yeah, so ultimately, whenever you step away from the sort of market cap weighted world, whether it's something as simple as equal weight or whether it's something, a little more complex like fundamentally weighted, ultimately you're making a decision to not just own the market cap weighted index. You're going to take a deviation and you're going to get a deviation in performance because of that. I think it is important to look at what the strategy is. Even going back to market cap weighted indices, we've talked about MSCI World versus FTSE All World. What actually is happening in the index, what's underlying it, is going to have an impact on performance. In the case of the FTSE All World versus the MSCI World, it's effectively whether you have EM exposure or not, emerging market exposure or not. And if emerging markets do better than developed markets, then the FTSE All World would outperform. And if they did worse, as they have done in the recent period, then the FTSE All World would underperform versus the MSCI World Index. In this case, we're talking about a fundamentally weighted approach. The reality of that, is that as I indicated earlier, you are going to be underweight stocks like the Magnificent Seven. Not necessarily because of their size, because if you think about the sales and cash flow numbers and book value numbers, perhaps for some of those stocks, they've also gone up at the same time as prices have. But you'll end up underweight them versus the market cap weighted index because the price has gone up by more than the sales number or the book value number has. So you're going to take a very much a value bias with this type of approach. There are a wide range of other ways of deviating from market cap weighted indices. Each of them will have their own approach and their own different characteristics, and it's important to understand what that means in terms of the risks that you're taking through that deviation.
Yeah, very comprehensive. Thank you. Now we are coming towards the end of the webinar. I've got about 15 minutes left, and I'm just conscious of time. Need to leave enough time at the end for Q&A. So I'll do a quick demo now, just to show how to buy the ETFs, which capture some of the themes that Chris has been talking about. So let me just tweak this browser over here. Here's what I prepared earlier. Here we go. So here we've got a dummy account to walk through. This is once you're logged into the Invest Engine app, either on the browser or on your phone. You can open up a new portfolio, or you can kind of select your existing one. I've also got a few portfolios on the go here. I'm just going to select this DIY one. Here we've got 50% equities and 50% bonds. You can see it down there. And what we're going to do is we're going to click Add Securities, which should bring up a nice big list of ETFs. And here we go. We've got Invesco at the top here. So we just click the Invesco tile at the top here, which takes us to the Invesco page on the Invest Engine website. So some good content here from Invesco. And then a nice long list of all of the Invesco ETFs on our platform. Today, we've been talking about investing globally. So let's have a look for some of the global ETFs. Now, very handily, the FTSE All World, which we've been talking about a lot today, is right at the top. But if you are interested, as that guy in the chat who's asking questions is in the RAFI, the fundamentally weighted ETFs, they come in a few flavors. There is a global one, there's a US one, and there's an emerging market one. I think the global one was, I'm going to put myself on the spot here, PSRW. Yeah, there we go. So that's the ticker for the RAFI All World, but you can just type RAFI in there and that will bring up your global one, emerging markets, and the UK. But let's just for now go for FWRG. That's our FTSE All World. And we're going to go into that one. Nice performance chart. Brief description of what it does. You can extend that to get a little bit more information on Invesco and on the index that it tracks. Some nice tiles showing you a bit more detail on what the ETF is. And if we like the look at that, we add to portfolio. We can see in the top right here, that's now been added to our portfolio. We click continue. And this screen here is where we adjust the weights. So I don't want any of this one. I want to stick it into there. So 50% in the FTSE All World. And this next screen here to look through. So you can see how that change impacts your portfolio. And it has a few different look through kind of screens. There's one on regions, one on sectors, one on holdings. If it ever loads, this is, oh, there we go. Nice, good. Now it shouldn't actually be too different because the previous ETF that I had in there was also an all world ETF. So we can see there's been a slight increase in North America, slight increase in Europe ex UK, but it's quite small. Sectors, a little bit of an increase in industrial, a little bit of an increase in technology, bit of an increase in financials as well. And then you can see how it impacts the actual stocks that you're holding in your portfolio as well. So we've got a 0.1 increase in Apple, a little bit of a decrease in Microsoft, a little bit of a decrease in Nvidia. But again, the differences won't be that big because the previous ETF was also tracking the same index. We click save and continue, and then we should get a nice tick. Yep, saying the target weights are updated. And we scroll down, and here we go. We can see that the target weight here for FWRG is 50%. So we've got 0% invested at the moment. We've got a 50% target weight. Now, what I need to do if I wanted to actually invest in the ETF is to rebalance my portfolio. And how I do that is I go to options and I go click rebalance like that. Now, obviously, it wouldn't work because I've got a demo portfolio at the moment, but that's what I would do if I wanted to rebalance to these target weights. If it was a new portfolio and you didn't have existing cash in there, you would click invest if you wanted to invest a lump sum, or if you wanted to set up a savings plan, that's your kind of regular investing option. You click on the set up in savings plan, and that takes you through the steps for setting up your monthly direct debit, or depending on how frequently you want to invest. So there we go. That is as easy as that. I am going to stop sharing my screen now and have a look in the Q&A box. We've got somebody with a raised hand. Unfortunately, we're not able to unmute participants. So if you do have a question, please type in the Q&A box and we'll get your questions that way. Okay, first question coming in then. One for you, Chris. Okay, somebody's asking why not just have a pair of ETFs? So have one developed market ETF and one emerging markets ETF for, I guess, greater flexibility and control.
Yeah, it's a great question, and I guess we've been focusing on global ETFs as a sort of one-stop shop for investing. You know, ultimately, if you have a view on exactly what we've been talking about, whether EM outperforms or underperforms, for example, you can build your own portfolios. And you know, you had a 2-fund portfolio there. You could easily make that a 3-fund or 4-fund or 5-fund, and the tools are out there. You can buy them. And adjust your your EM exposure to your will. The key thing is that does involve additional work for you. You've got to take a view and let's hope you're right. You've also got to manage that exposure. The advantage of something like the FTSE All World is, you know, if EM gets bigger because you know the number of stocks there are getting bigger, or those companies are growing, that's going to happen with the index automatically. You won't have to keep adjusting your weights and things.
I think that's my favorite bit of the global approach. It's just kind of set and forget. Don't need to worry about it. If emerging markets doubles overnight, fine, don't care. Don't need to rebalance. It's just already taken care of in the index.
And my next monthly payment will go into the newly reweighted index.
Exactly, yeah. We've got somebody in the chat asking, just on my demo there, how often you can adjust the weightings in the portfolio. So really, it's as often as you want. All you have to do is change your target weights in there, as you saw me do, and then go into options and click rebalance, and your trades will be executed at the next dealing time, which is once a day. And yes, the other question there from the same person, you can set up a monthly. Oh God, hello.
Hello, I can hear you now.
Oh, that was awful. My all my UFBs just stopped at once. Oh, we're still on. We're still on.
We're still on, I think.
Okay, good.
Okay, good.
Okay. Sorry, we're talking about, yes, there was a question in the Q&A. about direct debit. Yes. So you go onto the app or the website and you just click, there's a little banner that says set up a savings plan. You click that and then it gives you the options for how much you want to invest and how regularly you want to invest. So that'll take you through the whole process. Okay, let me get back to the Q&A box. Here we are. Okay. Currency risk. Yes, actually, that's a good topical question because one of your slides, there was a slight difference in performance because of the currency impact, right? So I guess that's an interesting question to answer. How should investors kind of approach currency risk when you're investing internationally? Because obviously a big slug of what you're investing in is going to be in dollars, right?
Yeah. So and whether it's dollars or whether it's euros or whether it's yen or whatever, you're always going to have a currency component. So if you buy our standard FTSE All World Index ETF, for example, effectively what you're doing is when you buy the shares in the ETF, you're giving that money to the fund managers, and they will go and buy the underlying securities in the local currency of that market. So you will be exposed to the performance of the currency when you come to sell your shares in the ETF. You'll effectively be buying them back in sterling, and whatever performances impact the currency has had will be passed through to you. I can give you a great example. If you look at the performance of the FTSE All World Index in sterling since the peak in the equity market, which was the 19th of February through to today, there's about a 4% performance difference between looking at it in sterling terms or looking at it in dollar terms. Now, and that's 4% worse if you're investing in sterling because the dollar has weakened and because some of the other currencies may have changed. The way that you can avoid that risk is you can buy a currency hedged share class instead. And we have what's called a portfolio hedged approach for that FTSE All World product. If you buy the currency hedged version, what the fund managers are doing is trying to manage that currency risk. You won't get the perfect performance in sterling terms as converted 1-for-1 from dollar or from euro or yen, because the way they manage that currency risk is through effectively agreeing a currency trade in advance, and that will depend primarily on interest rate differences between the two currencies. But you can take out some of that currency volatility. Thing to be aware of is if you are hedging, if you are buying a hedged product, you are taking a view on currency. So as I said, the currency unhedged currency exposure has hurt you would have hurt you over the last month, as it were, because of dollar weakness. Obviously, if you go through a period where the dollar strengthens and sterling weakens, you'll get more pounds per dollar in that scenario, and you would make money on the currency side. So it is a balance to take.
And something else which I think is probably underappreciated, especially when investing in the US, is how the ETF replicates the underlying index, right? So there's a couple of ways to do that. Firstly, would you mind explaining what they are? And then maybe explaining the differences between the two and what would inform someone's decision as to which sort of ETF they buy?
Yeah, so there are two ways to replicate an index in essence. One is physical replication, so buying the underlying stocks. And you may buy all of the underlying stocks, or you may buy a sample of them, depending on how complicated it is to track that index. But ultimately, the aim is to perform as closely as possible to the index. The other way you can do it, rather than doing it physically, is to do it through a swap-based approach, or so-called synthetic approach. And that's one where the ETF is still buying a basket of equities, but they're not buying the same basket as the same stocks as are in the index necessarily. And instead, what you're doing is truing up the performance of the portfolio you own to the performance of the index you track by entering into a swap contract, and swapping those performances. The advantages of doing that are in some markets, you can improve performance through better withholding tax rates. So the impact of withholding tax on dividends in the US, for example, on certain indices, you can reduce the amount of tax that is affecting you at the portfolio level. The other advantages are around how closely you track the index, because it's a contract. You're going to track, the index that you swap for, pretty much identically. Obviously, there are pros and cons to both approaches, but in certain examples, there is an advantage to using the swap based. So, for example, our MSCI World ETF, so that's the developed market product that we were talking about, is a swap-based fund because we're getting a withholding tax advantage in the US primarily, and we're able to outperform the best performing physical competes there because of that. Our FTSE All World product is a physically replicating fund, and the reason for that is that we're not able to get the withholding tax advantage because the index is a different index and doesn't meet quite the same requirements.
Yeah, that makes sense. Thank you. There's actually a question that's come in about kind of relative to what you said earlier. Someone saying, I've noticed all the world ETFs are still heavily weighted towards the US. Do you have any funds where the weighting is more equally distributed? This person missed the start of the webinar, so might have covered it already. So I guess the answer is yes. You have the RAFI ETFs that we went through, which are towards the end of the webinar, so hopefully they caught that bit. But you do also have the equal weight ETFs, which you mentioned as well. We've talked through the tickers for the RAFI ETFs. You just literally just search RAFI on the under the Invesco banner. But I just did a quick look there, and the tickers for the global equal weight, so the MSCI World equal weight, MWEP, that's on the InvestEngine platform, and there are a couple of S&P equal weights as well if you want to take a more US-centric approach.
And to give you a number on it, the weight of the US in the MSCI World Index is something like 70-ish%. So the standard market cap rated index. In the equal weight index, it's around about 40%. And for the FTSE RAFI index, it's somewhere between the two.
Okay, yeah, that's helpful. Thank you. In terms of costs, there's always somebody asking about costs, which is good. The RAFI All World ETF, I checked beforehand because I knew somebody would ask this question. It's 39 basis points, 0.39%. And FWRG, that's the global tracker, that's 15 basis points, so 0.15%. And interestingly, that's one of the most popular ETFs on the platform. I was looking at the flow data yesterday, over the last 12 months, I think it was, and FWRG was in the top 3. So a really popular ETF. Right, we're 1:45. We've probably got time for one more question. So let's have a look and see what we've got. Okay, this is quite a general one, so probably a good one to finish off. It's been a pretty turbulent time for markets over the last few weeks. Is now a bad time to begin investing in equities, or does it not really matter for long-term investors?
Yeah, that's the easy question for the not so easy question for the end. So I guess the key thing is, what are your investment horizons and what are your expectations, and how are you investing? Those are the kind of key things that you need to be thinking about. So if you're investing in the sort of the monthly approach that Andy mentioned earlier in his demonstration, the sort of fluctuations of when you get in and out of the market don't matter so much, and the technical term for that is called averaging in. So if you're averaging your investment in, you're less affected by whether the market is up sharply or down sharply on a given day. If you're putting in a lump sum amount, and we're coming up for ISA deadline for the end of the year, it can have more of an impact. So obviously, if the market's drops another 20%, you'd be better off waiting, I guess, is the answer. If the market is going to rally from here, then you probably want to get in after a 10% drop. So it's always that. That balance, and ultimately it boils down to kind of where do you think we are? Do we think that the sell-off that we had in particular in the US market is is a sort of healthy correction in a long run upswing, or do you think that this is the start of, you know, a bigger sell-off in the market? And there will be 1,000 other commentators who will give you conflicting views on that until the cows come home. But, you know, that's kind of where you have to make your decision.
Lovely, thank you very much. We have just gone over time, so that's about all we've got time for today. If we haven't answered your question, there's been loads that have come through, and I'm sorry we didn't get to answer all of them, but we will try and get back to you over the next few days. You can always email support@investengine.com with your question, and we'll get back to you that way as well if you'd like. If you want to find out more about any of the ETFs that we've spoken about today, just click that Invesco tile that I was showing you before at the top of the investments page, and you'll find all the details there. So all that's left for me to do is to say thank you, Chris, for your time today. I think it was a really good discussion. And thank you also to everybody who joined. And I look forward to seeing you all on our next webinar.
Thank you very much.
Thanks.